Hey, everybody. Welcome back to Investing Unscripted, where we ask and answer the hard questions about investing. I'm Jason Hall, joined by my good friend, the voice of the people, Jeff Santoro. Hey, Jeff.
Hey, how are you?
I'm good, and I'm excited because we're starting to really get a lot of engagement in our Discord for members of our starter position on Patreon. And this idea for this show was actually the product of a conversation and something one of our Johns brought up. We have at least two Johns so far. John Denley had this sort of idea about incentives and the focus on short-term information when we're trying to compound and create value over the long term. And I thought it was, you and I both agreed, it was really compelling. I thought maybe this would be like a good thing for the mailbag. And then as we started probing it more, it's like, there's a show here.
Yeah, because I think it gets to the essence of what it is to be an investor. And when I say investor, I mean someone who buys and holds stocks for the long term, not someone who trades in and out, because you're constantly balancing the near term, the immediate noise or news, the quarterly report, the annual report against the decades plus timeline that hopefully you're planning on holding it for. And it applies to everything, right? It applies to just, like I said, the quarterly reports or the annual reports. It applies to how you think about the macro and how it impacts. Like this balance between the near term and the long term is very much what was on my mind throughout April as we were dealing with all the tariff noise.
Yeah.
You know, you think about what's in my portfolio, how's it going to be impacted because of the tariffs? But then you think, all right, but maybe the tariffs, even if they were consistently employed, are probably only a one presidential term thing. Like you would imagine another president, especially if it's of a different party, would roll a lot of those back. So if you're thinking 10 years down the road.
That's even assuming that they get through the Supreme Court, right?
Right. I'm just saying, like, I said, and assuming they were even just put in place and left there and it was stable, which it is not, but just assuming that, you would think this is one of those things that would change in January of 2029. So I'm planning on holding my stocks longer than that. So I was always balancing the near term and the long term. So that, this is a great, I think, conversation to have. And it's probably something everyone deals with. So why don't I read the suggestion here and then we can dive in.
Yeah.
So John said to us in our Patreon Discord, I have a suggestion about how we manage our long-term perspective with short-term information. Most of us are looking to have holdings for years or even decades, but we evaluate these through quarterly earnings and company news. Maybe the question is how we interpret the current data with a view of the future, or balance or merge these points of view. So that's the question / philosophical query. So I think it would be good, Jason, to kind of have this conversation if we started talking about the big picture things that you and I look for when thinking about what stocks to buy. Like, what are the drivers of long-term value that we look for? And then maybe we can talk through the near term using some specific companies from our portfolios.
Yeah, I think that's a good idea. Before we even do that, though, John's last sentence was, not sure I'm doing a very good job of explaining this. John, you did a terrible job, but what you did a perfect job of doing is giving us an opportunity to talk about it for 45 minutes. So I'm kidding. I think you did a really good job because there is that tension. And one of the things that reminds me, Jeff, is the show that we did talked about goals versus incentives. It's been over a year ago, I believe, or maybe about a year ago we did that show, is that we have our goals, but then, and the goals might be something 6 months from now or 25 years. The time frame for those goals can be very different, but then we have our incentives, right? And incentives can include things like impressing your friends, growing your earnings, making sure your wife doesn't think you're going to lose all of your money because now you're buying stocks instead of just leaving the money alone in savings, right? Those things are all incentives that affect us, and they can become disaligned with our goals, right? Like the incentive to not lose money in the near term is tied to fear, right? And that incentive can be more powerful than our focus on our goal. So I think that's a big part, like from the psychological part of choosing to decide to be an individual investor where you're actively making these decisions and you have the power to blow things up in minutes, I think is a really important part of this conversation.
Yeah, I agree. And I think when we talk later about specific stocks, you have a good example of this with one of the biggest holdings in your portfolio. So we'll come back to that idea near the end.
Yeah. So with the long-term drivers.
Yeah. So let's start with some of the things that we look for, especially if we're looking for a new investment, right? Something we're going to add to our portfolio for the first time. And this first one I want to talk about is one that I've come to value near the top of my list. And it's one that you've talked about a lot. Like I remember you saying this to me a lot when we were first internet friends, which is secular tailwinds, right? So I remember
I thought it was, why are you DMing me?
although this is a good time to point out that until very recently, I was in your phone contacts as Jeff, oh my God, why is he so weird or something like that?
No, you still are. Jeff, God, he's so weird, Santoro.
Okay.
You still are.
Well, you're in my contacts as
executive assistant.
Yeah, to me, of course. But anyway, so you used to talk a lot about, and I know this is still a big thing for you, about trying to find companies that are big players in big important industries or sectors. And I've come to adopt that into my own investing strategy because I think it makes a lot of sense, right? If you're trying to think on the longest timeline, it makes sense to say to yourself, what is an industry that's going to be here in decades? And who are the best companies in that sector? So like for me, when I think about that question, obviously AI is the newest one. I believe that I think you and I are on the same page that this will be a thing in the future. I think it's to be determined who in that space is the player because it's newer. But one that I think is pretty established already is cybersecurity. To me, that's always the first one that pops into my head, right? We're going to need more of it. It'll be bigger 25, 30 years from now than it is now. You know, as we become more online and more things are in the cloud and there's more AI, there's going to be more threats, which means we're going to need more cybersecurity. So it's hard to think of a industry that has more tailwinds than cybersecurity, right? It feels like that might be near the top. But what's another industry, like when you think about 20, 30 years from now that you're pretty sure has a long growth runway ahead of it?
There's a few, and we can go through it. And I think not even just talk about the ones that I think going forward have the opportunity, but maybe looking back to see the ones that we thought were going to be really big, and maybe they are big and they've become big. But the most important is identifying not just nascent industries that are going to become very, very large or they're going to be disruptive, but the ones that they're actually going to create value for investors. Before we even talk about the ones that I think going forward might be good, I want to talk about two that have been enormous over the past 15 years. They're both facing some headwinds right now, but they've both been enormous. And with very few exception, they've generally been massive money losers for investors. And that's renewable energy and electric vehicles. So in the electric vehicle space, besides Tesla and to some extent, I guess NIO, is it NIO, I think? One of the Chinese EV companies from ORLY. The vast majority of investors that have invested in EVs, especially anybody that's tried to find the next Tesla over the past 5 or 6 years, has resulted with a lot less money than they started with, right? It's been very value destroying. And the funny thing about it is that describes really the auto industry over the past couple of decades.
Well, that's what I was going to say. Like, to me, because I actually wanted to talk about renewable energy too. And I'm glad you brought it up because it feels like with both of these, EVs and then renewable energy generally, assuming those become the dominant things, let's say 50 years from now, let's just say most cars 50 years from now are electric vehicles and most energy is produced renewably. Don't we just end up in the same spot in 50 years that we are now with fossil fuels and ICE cars, where they're crappy investments?
Here's where the dynamics play out. So if we talk about what's happening with EVs, there was this massive land grab period. Tons of capital flowed into the industry to try to build out manufacturing capacity. We've seen the demand gets weakened because the tech's not quite there. The infrastructure is not quite there, like all of those things. And it's like the cyclical impacts of the reality of selling something expensive have kind of come in. And what I think the industry has also been reminded of is that by and large, if you're selling cars, you're a price taker with very little exception, unless you're Ferrari or Porsche.
Right.
You don't set the price, right? You take the market, what the market gives you. And the way you make money is through scale. You get to scale, you find ways to drive out cost, right? And by driving out cost, whatever the price you're taking, you can make money, right? And I think that's the lesson that the automotive industry is learning. And in renewables, and again, Tesla is kind of the lone exception. One of the Chinese automakers has done okay too, but they're just car makers now and they're cyclical businesses and they've suffered. If we look at the solar space, we don't even need to talk about wind turbines and all that kind of stuff. If we just focus on solar, essentially First Solar is the one winner that's over the long term. Enphase and SolarEdge I know Enphase is still making investors money over the past 10 years or so, but residential solar has been hit so hard over the past 2.5 years, and they're both down so much. A lot of the gains that investors saw over the prior decade have been washed out there. But First Solar is the lone exception of a company in the solar industry that's made investors money. Solar has been the largest capital growth part of the power grid globally just about every year over the past decade. More money has flowed into building solar than anything else, natural gas or nuclear or anything else. So the money continues to flow there, but it's not flowing to investors because there was this idea for a lot of investors that this is a tech forward, innovative, lean in kind of business where the innovators are going to win. And some of the biggest innovators like SunPower went bankrupt, right? Because it's a commodity price taker business. It circles back around to that. And First Solar has been a winner because management has been smart about managing R&D to keep an edge, but also leveraging their technology smartly and prioritizing over everything else a strong balance sheet so you can get through the cyclical downturns and keep the business strong and make money when everybody else is in trouble and really make money during the good times because they operate their business more like Nucor, like a steel maker, than they do like Google.
All right. I want to stay on this topic of long-term tailwinds in industries, right? Because I want to contrast something like cybersecurity against renewable energy and EVs. But I want to bring up our second kind of big bucket because I think it's related to this, which is finding stocks that have competitive advantages that can last for decades. And this is where I think these two long-term industries are different. So I think of cybersecurity as an industry that has a long growth plane ahead of it. I think I'll put EVs aside for now. I think renewable energy is an industry that has a huge runway ahead of it as well. I don't view them equally in terms of investing because of the competitive advantage aspect. And I think this is exactly what you're getting at, right? So if you think about cybersecurity, I think there absolutely will be huge winners in that space because it is going to grow. There are already leaders. They will continue to take that market share. And it's not going to be a price. I don't think it ends up in a commodity space where they become price takers. With EVs,
I'll challenge that a little bit in a second. Go ahead,
okay.
And then I'll.
With EVs, I actually think there may never be another Tesla, and they were the only stock you could have.
Oh, absolutely.
You could have grabbed onto and gotten gains out of in the EV space because now I think
in the same way that Apple's the only Apple in the smartphone space.
Yeah, like it feels like it's already on its way to being just commoditized down to regular auto margins. And so it's like, it's just a different product. Internal combustion is gone and now EVs are in. With renewable energy, I still think there's an opportunity because that's a whole infrastructure that still needs to be built out, right? There's the solar panel aspect if you're talking about solar, but then there's also, transmission lines and the whole grid and batteries to store the energy. And that's just solar, right? That's not talking about wind and any other sort of renewable energies that we're not mentioning right here. So this whole idea of competitive advantage is where I actually I think about it so much, I think it prevents me from taking on risk because I poke holes in every single company in terms of its competitive advantage. Because I'm thinking to myself, what makes this stock or this company the winner 3 decades from now or 2 decades from now, like when I need to start selling these stocks to turn into retirement income. And that's hard to predict. And I find myself finding reasons why every single company is not one that has a competitive advantage. But whereas I used to not think about that at all, and I bought everything, and then I found out like, oh, this company has no advantage. There's nothing this company offers that its competitors don't. And then that's why I've sold a lot of things. So anyway, that's how I kind of balance those two. But you wanted to push back at me about cybersecurity not being commoditized. So go ahead.
Yeah. I want to push back a little bit because I think in a way that's actually bullish because one of the things I've come to believe over time is that the idea of economic moats, I think is very misunderstood and they're far more rare than people think. And Lou Whiteman and I actually did a live stream together and we talked about this a lot. There was this show that was on before us and the guests were really talking all about moats and moats and moats and moats. And Lou and I were messaging back and forth in the kind of the green room thing on that app. And Lou was lit, is the best way to put it. So we addressed it on the show and talked about some kind of misconceptions about the idea of moats. I think companies that have moats in a lot of cases, if they're real and durable, those companies get lazy and they lose their edge and they end up getting disrupted. We could look at Alphabet right now with Google. Google search sucks. Like, it's not good compared to where it was a few years ago. It's trash. Unequivocally, it's trash. And it's set up to get disrupted, whether they're able to leverage their own AI to be part of that disruption and also to get better return on their ad-driven businesses. It remains to be seen. But I'm far less bullish on Google Alphabet now because of I think the eroding moats that we're seeing at Google. And then look at Coca-Cola, right? This is a company that obviously has one of the most powerful brands in the world. It has massively underperformed the S&P 500 over the past 30 years. It's been a fine investment. It's been better than owning a bond, but it has trailed the S&P by, I don't know, close to 1,000 percentage points at this point. It's substantial.
Yeah,
like how
the
much
idea that moats aren't permanent, I think, is important because, like, here's another company,
and also that they guarantee outperformance, right?
Yes.
Those are falsehoods.
Here's another brand moat that I think actually still is intact, but is in danger of not being, and that's Apple's. Because we did a video a week or two ago about Apple's AI ambitions, and where I am with that company right now is I do think their brand is still a moat. I think people are attracted to owning Apple products. I count myself among them. But at some point, when the 15th straight year of iPhone iterations is just a better battery and a slightly nicer camera, like, do you start to see people not have that brand loyalty because there hasn't been this flashy new innovation? Now, could AI be the thing that reconstitutes that brand moat? Maybe. But the idea that you might have said Apple has a moat doesn't mean that 5-10 years from now, Apple will still have that same moat. So I think that's a good point.
So again, the idea of permanence and long-term, I think, is what we're trying to focus on here.
Yeah.
So circling back to the AI and commoditization, I think a certain amount of commoditization is healthy for businesses because it means that there's competition and it means you have to compete and you have to fight. And it's when companies don't. We can look at 3M over the past really 20 years. We could look at Boeing, the disaster that's been Boeing, a company that essentially has operated in a duopoly since the early 2000s when it made its last big acquisition. Those companies get soft and they stop innovating, and it turns into financial engineering to try to wring the most profit out of the business. And then you really start to lose your edge because now you're not spending on R&D, you're not being challenged, you're not having to pivot. So I think in cybersecurity, while maybe commoditization is not the right way to think about it, but disruption certainly is.
And the fact that there'll be a lot of winners, I think.
I think there will. I think there's going to be multiple winners, but because I think the companies are going to have to innovate and they're going to have to stay because it's cybersecurity, because the people that are trying to do the harm, trying to get through the firewall, that are trying to get passwords, all of those things it's a constant battle. It's an arms race that never ends.
You know what it reminds me of?
What's that?
Not in the same, it's not the same business model, but I wonder if we end up in a place where it's similar to insurance, right? Like, different model, I understand, but remember,
where just the thing that it's not optional.
It's not optional, and you have tons of places to go get that protection, right? I can pick dozens of companies to insure my house or my life or my car. And I wonder if we end up in a place where cybersecurity already is kind of table stakes for a company of any size, or not even a company, even the public sector, like schools and universities and governments, right? Like anything online is going to have cybersecurity. But
if you have information,
CrowdStrike or Zscaler or
if you have information that somebody might want, you have to have it.
So that's where I agree with you. I think in the future, that's kind of what it'll be. You need it and you can get it from anywhere. And I would imagine the difference between these companies, the gap between them in terms of differences will start to shrink over time, and you'll see more of them do some of the things that others do pretty well. But I think that could take a really long time. But it still feels to me like it's a sector that will grow, I don't want to say exponentially, but a lot.
I think that's right. And there have been some big winners in the software industry too. So I think that portends a reasonably decent future for investors, as opposed to the bloodbath that we've seen in EVs startups over the past 6 or 7 years, and the tough go in solar. The point of the conversation around the losers, I think, is maybe more important than the conversation about the winners, because you can find big tailwinds everywhere. It's finding the ones that are going to create value for investors that's so important. And part of that is finding areas where there are characteristics that can create results, like positive results. So here's a good example, I think. The airline industry has grown a tremendous amount over the past 30 years, and the secular trends are very favorable for that to continue. The world's middle class is getting bigger. People want to go more places, right? We know the opportunity is there. Boeing's been a disaster, right? a company you think that should have been a massive winner over that period. TransDigm's been a massive winner over that period. Most people don't know who the hell TransDigm is. TransDigm is constantly fighting against competitors in its space, largely supplying the commercial airlines, right? Which also broadly haven't necessarily been very good investments. But TransDigm's been a huge winner because it's found a niche. And that niche is its size on a company's operating statement of the expenses, the money that they give to TransDigm is tiny compared to the importance of TransDigm to their business.
You need a part that keeps planes from falling out of the sky, but you don't need a lot of them.
The cost of that plane sitting on the tarmac far exceeds TransDigm's premium because you know they're going to get the part quickly and you're going to be up and running, and that plane is going to be generating revenue, not costing you tons of money. They've built a strong business, and they've had to stay lean, and they've had to continually fight against competitors to stave off competitive threats, making bolt-on acquisitions and expanding. But the point is their importance to the market they serve is more important than maybe shaving 5 or 10% off the price that they charge. So they've been able to get really good margins and results because of that. And then on the other side, you can look at industries. Like one of the things that gets talked about a lot, and to a certain extent, maybe this is a headwind for the EV industry, is the age of the average car on the road in the US. Every year that goes by, the average car on the road gets about 6 months older because cars last a lot longer than they did in the 90s and certainly the 80s and 70s and before. Cars are just more reliable broadly, but lots of stuff still breaks on cars all the time. Bulbs go out, windshield wipers need to be replaced, brakes need to get done, batteries, like all of that kind of stuff. And as a result, O'Reilly Auto Parts, this like business that gets like 3 or 4% net margins, has been a massive winner because in a highly competitive business, they've been really smart about being a really good retailer. And so what do you do to be a really good retailer? Well, you keep your costs and expenses low, but not so low that you don't provide good service. You have to provide good service, but really focusing on their inventory. They've done an extraordinary job, a better job than almost anybody else in their industry of having good parts availability, but the parts that they know they're going to turn over quickly, turning those things over really, really quickly in such fashion that they're generally, for a lot of their inventory, they're getting paid to sell it before they have to pay the supplier that they're buying it from. They're turning that inventory over quickly and turning it into cash before you have to give the cash to somebody else has proven a major advantage. So it's one of those things that you don't have to find super high margins to get really, really good returns because you get to use other people's money versus your own capital, which your cost of capital becomes zero. And it's just a beautiful compounding effect. And when your margins are lower, you don't have to deal with the Jeff Bezoses of the world that are saying your margin's my opportunity.
Another company that has that same dynamic is Costco. They're able to turn their inventory and sometimes basically sell the product before they ever have to pay for it.
And also knowing their customers really well and getting to a scale where they are aggressive as buyers to get good prices, to get good costs, but then not gouge their customer because they know the value they create is why they get 91, 92% of their customers to renew their membership every year. And that membership is the profit.
Yeah. So another thing I think about, although I want to ask what you think about this because I'm not sure you agree with me, but also I think this is a little bit of a medium term or maybe even short term way to think about the long term, which is the degree to which any company has resilience to economic conditions. And I don't necessarily think of this in terms of, oh, will this company go bankrupt the next time we have a recession? I think of it more around the risky way some companies come public in boom times, right? Because this is on my mind after the 2021 SPAC boom, where a lot of these companies came public that probably shouldn't have. A lot of them have since gone back to being private or have been acquired by other public companies, but they basically came to the markets under the assumption that we'd have 0% interest rates forever. So debt was free. And then when we didn't have 0% interest rates, the question was, can these companies stay afloat? Are they going to have to constantly go out and get new capital at higher interest rates and so on and so forth? That's the lesson I learned from 2021. And it plays into the way I think about how risky I want to be on newer companies that come public now. So if a company comes public now that is high revenue growth, but unprofitable, burning a lot of cash, I think differently about it. I think about, well, what happens if interest rates go up from here?
Mhm.
or what other economic things can make these kinds of companies not even be able to survive. So I'm just curious how you think about that idea of long-term investing.
Yeah. So kind of, I want to answer this in a couple ways. I want to unpack the idea of companies going public and thinking about when to invest in them. And that's one of the reasons. This is exactly one of the reasons that generally I try to avoid investing in companies soon after they go public, is to figure out what are they going to do with the proceeds of that IPO or SPAC merger or whatever it is. How are they going to utilize that capital, and what are those implications for the cyclical realities of doing business? And one of the things that I've come down on is like the idea of companies that can thrive in downturns, I think it's oversold, because that's when you end up with a Costco trading for 50 times earnings, or Coca-Cola trading for 25 times earnings. People pay a premium for certainty, and they're buying underperformance, right? As a result, which, I mean, I guess that's fine if you're, depending on what your goals are. But if you're investing in a company, if you're buying a stock, you should have a goal of outperformance or a high level of income, right? And income growth for dividend growth stocks, that kind of thing. So when you're buying those safe, secure companies, you're not only are you paying for underperformance in a lot of cases, if you're buying them when things aren't great, but you're buying businesses that probably aren't capitalized properly. They have too much reserve, and all of that reserve sitting around generates a lower rate of return. So I've come to the conclusion that companies that are built in a way where they have some leverage, but not too much, they have some cash, but not too much cash, generally are probably the ones that are going to generate the best long-term returns. They can get through the downtimes, but then when the downtimes are over, they're capitalized well to remain nimble and start generating excess profit. And we know, because of the way the balance sheets are structured, they don't keep a lot of that capital. They buy shares, or they send it back to investors in dividends. They do things with it. And those are the ones that tend to be the great long-term winners. Now, we don't know that with companies that go public. I'll use STEM as an example. This was one of the SPAC mergers. I was really interested in it because the guy that led the SPAC had a pretty good reputation in the energy space and wasn't just some shill. The problem was the people that were running STEM, and the CEO at the time is now out. They basically blew all of the cash that they got from the SPAC to make an ill-advised acquisition. The acquisition normally would be fine if your core business was generating positive cash flow. Their core business wasn't generating positive cash flow. They were pouring money into that business. So you take your reserve and you blow your reserve on a business that's losing money, and you bolt it onto your existing business that's losing money, and then interest rates skyrocket 6 months later. And here we are, right? They just had to do a reverse split because their stock was trading for 70 cents a share. So the point is that the idea of companies that can thrive in any environment, I think, leads us into overpaying for really good companies that don't have great prospects to outperform. So that's kind of the way I think about that. Back to the idea of secular trends, though, that can create opportunity. We talked about that before, and I want to use one that's just been enormously beneficial for me, and that's the growth of the global middle class. And one of the things that's come along with that, and that's improved access to healthcare. And as technology has advanced, healthcare can be hit or miss depending on where you invest. Like if you invest in a company that operates hospitals, you're probably going to lose money. They kind of suck because the margins are tough, and you have to give treatment to anybody that comes in your ER and like all of those things. But you know who makes a lot of money? The companies that are involved in healthcare technology. Intuitive Surgical is a great example of that. Is perfectly positioned to benefit from all of the trends around more money flowing into healthcare, increased access to healthcare, but also came to market with the product that we now have. We're getting on into the second generation of surgeons. This is how they perform surgery with the Da Vinci robot. And they've added use cases, and it's a perfect business model that's built to be profitable, because not only do you make money selling the quote unquote the razor with the Da Vinci, which are expensive and they get some profit on it, they make margin on it, but you also sell the consumables that get used for every procedure. And as uptake increases for their units, that part of the business, which is extremely high margin, gets better and generates more profit. And I bought a very small position in the company 12 or 13 years ago, and it's up, 11 or 12 fold at this point, just because all of the trends, all of the things continue to play out favorably. And the people that should worry about and deal with the short-term things, the management of the company, they navigated that very well. And I didn't mess it up because they had a weak quarter. or sales in Japan got soft.
Right.
And those things that can lead you to blowing up a perfectly good thing because it's a short-term pressure. You're like, okay, things aren't going well. All right, I'm going to take the money off the table, whatever the gambling word we use is, right? It's all our own money. It's never house money. You're the house. It's your money. It's your wealth. And as long as the business can continue to succeed, and fortunately, my wife works in healthcare, so I generally ignore the space. So I ignored the stock, read the annual report, and just understand the trends. I just left it alone, and thank goodness that I did.
All right, folks, if you're a regular listener to Investing Unscripted, then you know that we use Fiscal.ai, formerly known as FinChat, daily. Fiscal.ai is our complete stock research terminal. It's where we have our investment dashboards. It's where we create financial charts. It's where we read all the transcripts for the conference calls, sell-side events, shareholder meetings, and it has Morningstar's high-quality research reports on more than 1,700 companies. It really is the complete research platform for stock-focused investors. If you use our link, fiscal.ai/unscripted, you will get an automatic 2 weeks of Fiscal Pro for free. And if you find that it's worth upgrading, you will get 15% off any paid plan with that link. Again, that's fiscal.ai/unscripted. The link will be in the show notes.
Hey listeners, my name is Brett Schaefer, one of the hosts of the Chit Chat Stocks podcast. On our show, we do comprehensive stock research reports, interview analysts, and learn from great investors. And we have coverage on stocks like Airbnb, Nubank, Mercado Libre, and many others. Plus, we cover all the hot financial news on our weekly investing power hours. We have episodes for all types of investors, and think if you listen to this podcast, you will enjoy ours as well. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts, and start discovering new investments today.
All right, so this is the perfect way to segue to the second half of the conversation, which is let's talk about individual companies that we own and how we think about the results we see quarter to quarter, year to year, and how they impact these long-term drivers. And Intuitive Surgical is a great example, right? Think about the things we talked about, secular tailwinds. You just talked about how they play a role in large secular tailwinds. Competitive advantage. They are the robot, they have the robot system that all these surgeons are trained on. Very difficult to tell a surgeon who spent 20 years using the Da Vinci, hey, now you're going to use this other robot.
No, because what's going to happen is the surgeon's going to say, now I'm going to this other hospital.
Right. Exactly.
Yeah.
And resilient to economic conditions, right? People need surgery whether they're in a downturn or not. So let's use our sponsor, Fiscal.ai. And by the way, if anyone likes the charts we're about to use, you can go to fiscal.ai/unscripted and use our promo code to get 15% off any of their paid plans. And this is a really great platform. They're adding to it all the time. It used to be FinChat. If you heard us talk about FinChat, they rebranded as Fiscal.ai. Same platform, just different name. I want to share a couple KPIs that you would want to follow in Intuitive Surgical. I own this company in my kids' accounts, Jason, so I don't follow it super closely. But here on the screen is their Da Vinci system installed base. Every year, this is full year results, but looking at it going back to 2012. So to me, Jason, and you can tell me if you disagree, if I'm investing in this company, this is one of the things I want to see, right? I want to see the installed base of these robotic systems growing year over year over year. And since 2012, they've grown their installed base at a compound annual growth rate of about 12%. I'll take that forever. Yeah. That's great.
There's two things behind that for a company like this. So number one, it means that they continue to sell machines. I think that's incredibly important, right? There continues to be strong demand for the machines. So the other thing that I think is important is how that drives essentially recurring revenue, right? For their business, for the consumables and the services that they provide. And since 2012, Intuitive Surgical's revenue has increased 400%. So the revenue is 5x. Over that same period of time, earnings per share have 5x'd, right? So there's a clear line of driving profit to the bottom line through continued selling the machines. Just an important thing to remember that following those sorts of metrics and does it lead to value for investors? And in the case of Intuitive Surgical, there's no doubt that that's happened.
Here's one more. Here is the number of Da Vinci procedures performed every year since 2012. And again, this has grown even faster, 16% compound annual growth rate year over year. So
yeah, for those listening, from about $500,000 a year to 2.8 million a year.
Yeah. And the trailing 12 months is about 2.8. And I think you said something really quickly a few minutes ago, like how looking at the long term keeps you from freaking out when sales in Japan are low for one quarter. So one of the tricks I have for myself, and I don't know if you ever do this, Jason, is when there's a quarter that's iffy or a couple quarters that's iffy, sometimes I'll zoom out and I'll look at full year results. And that can really give you perspective. And compound annual growth rate, I think, is a fun way to think about some of these growth things, because what that basically does is it takes the growth over a long period of time and evens it out. So especially if you see something that's very choppy, right? Like maybe it grows 50% one year and then 3% the next, and then 16 the next, and then 2% the next. If you look at compound annual growth rate over that period of time, it'll even it out. And so it's basically, if things were evenly distributed, what would the growth rate be? And that, to me, helps a lot with perspective, because you have to remember that any business, even the best businesses in the world, have periods of time that are going to be less good and periods of time that are going to be better than maybe average. It's like baseball, Jason. There's that old baseball adage that your team is never as bad as it looks during its worst stretch, and it's never as good as it looks during its best stretch. And I think that's true with companies too. A good example in my mind is Amazon a few years ago, when they were spending all that money to grow out the distribution footprint during the pandemic. Everyone started to say, oh, they're done. They're losing, their operating income is negative in the e-commerce segment. And then it just took them some time to get through that. And they've been fine ever since. And the stock has recovered and it's still in the Mag 7 and all that. And that's one of the best companies in the world, right? And it still went through a year or two of a struggle. So zooming out, looking at full year results, looking at compound annual growth rates, I think is a good way to keep your head, see the forest for the trees, so to speak.
I think the important thing for both of those, and they're good examples, is context, is not just what's going on, but why is it happening? So the Amazon was a good example. When their financial results were weak, it's because they had pulled forward a lot of customers and they had deployed a tremendous amount of capital. And after the capital is deployed, then the operating expenses tied to that capital started to kick in. In a lot of cases, that happens before the revenue comes. And the opposite is true too. When you're cutting costs, sometimes cutting costs comes with additional costs, like severance expense and things like that you have to soak that cost up, that expense up, before you get the benefit in the future. Right. So a lot of that's what happened with Amazon. And if you're just looking at the top line and the bottom line, and you're reading the headline and the quick blurb and the take, without taking the time to really understand the why behind whatever's going on with the numbers, then it's going to lead you to making decisions that are probably bad outcomes. You have to be careful with this. Yeah. Because again, our incentives and the way that we're wired, and sometimes we feel like we have to do something, we will look at those numbers through the lens of our own bias. Whatever, like, I better get out before things get bad, or the stock's down, I need to load up. Like, you're automatically predisposed to do one of those two things, whether you know it or not about yourself. That's how you're wired.
This is where the whole idea of balancing the long term and the short term really comes in. This is the essence of John's question, because if you and I talked about Amazon a lot at the end of 2022, heading into 2023. And the conversation we were having was, yes, things are rough right now. They're spending a lot of money. They're losing profitability in their biggest, most important segment. Thank God for AWS. Like, that was the only thing keeping their operating income above water for those couple quarters. Right. But when you take a step back, take a breath, and think to yourself, okay, why is this happening? And how does this impact 2050?
Yeah.
What I kept coming back to was, this is a expense that will grow the business. And I don't think people are going to be spending less on Amazon in 10 years. I don't. And I don't think they're going to be using AWS less in 10 years. Now, that's different than the Google example you brought up before. Mm-hmm. They actually could be getting disrupted.
Right.
And then here's another good example from the last couple of years. I don't like this company. I don't follow it. I would never buy it. But Meta, right when they were having, right before the quote unquote year of efficiency, I was certainly one of them who thought, this is it. They've lost their magic. Mark Zuckerberg's a moron. He's spending all this money. And then he decides, okay, we're going to have the year of efficiency. And they did. They still burnt a lot of cash in Reality Labs, but they got their house in order. And the stock went up, I don't know, like 300% over the next year. And again, in hindsight, that was maybe a little bit less clear, right? Like, maybe something was going wrong with the business. But this is where
the story there is the ad market got healthy, right? I mean, but
that wasn't the only thing. There were other things that were impacting the business then. But I think those are just a couple good examples recently of where you could lose the forest for the trees and look at what's happening now and forgetting, okay, but what is this business going to do down the road? I just think that's where you really have to not forget why you bought the stock and what your long-term thesis was, and always be looking at the current results and the current news through that lens of the long-term thesis, if that makes sense.
I want to throw out a couple more examples of kind of some near-term pressures in industries and companies that I follow closely and own as examples of trying to navigate through like this kind of squishy part of basing decisions that will have long-term implications on short-term pieces of information, quarterly results, like John was talking about. And this is going to be two industries that we've actually talked about here, just because I think they are really important part of this conversation. And I'll start with Enphase, right? Because Enphase stock is down a tremendous amount. I'll put this out there too. It's one of the stocks that's in our Savvy Trader portfolio. We made a decision to buy a starter position in it a few months ago. And at the time I said, look, I don't know what's going to happen in the near term. The stock could continue to fall, but I think this price is going to work out well over the long term. It certainly hasn't worked out over the short term, right? Because the new spending bill that's bouncing around Congress will probably start to phase out some of those tax credits that have been important for solar, especially residential solar. The day that House bill got sent to the Senate, the stock was down like 25%, right? Way down. But I've called a bottom. I said, look, I really think maybe not for the stock. I think maybe for the stock, but certainly I think we're probably through the bottom for the cycle for residential installations. So I think Enphase is really compelling here, because what have we learned about the company over the short-term information they've given us over the past 5 quarters? Even as the business has eroded substantially, like at one point, I think their units for the microinverters that go on this residential solar panels, unit sales were down like 70% from like the best quarter to the bottom. Like it was down, the microinverter sales were down a ton. And if you look on the screen, Jeff's bringing up something on Fiscal AI, if anybody that's watching, kind of showing that. But we probably hit a bottom a couple of quarters ago.
Well, it's interesting. At the end of 2024, microconverters shipped was 6.5 million. And then, for the trailing 12 months, it's 6.7, right? So we'll see how the rest of this year shakes out. But you're right. They could be slowly working their way back up, because before that, the growth was pretty incredible.
It was enormous. Enormous. I think it peaked in 2023, but on a quarterly basis, looking at the quarterly shipments, the bottom was in the third quarter of last year. On an annualized basis, we're finally coming through it. But again, the key is that the company generated free cash flow every quarter, not trailing. Literally every 90-day period, they were still generating positive free cash flow. And it wasn't weird stuff like working capital and depleting inventory. It was just like a healthy working through the cycle and keeping the business strong. So I still see this as the secular trends are enormously positive. And this is one of a handful of businesses that's proven that it does have some real strengths. If you look at their margins and the cash flow that this business consistently generates, it's a really, really high quality business. And it would have been very easy, Jeff, 6 months ago, a year ago, to say, hey, this is dead money. The business is in trouble. It's never coming back. And just sell and move on. What we're going to find out is either I'm right, or the bias that I have about optimism and that I followed this company so long and like those sunk costs, whether I'm just too optimistic and I'm wrong. We're going to find that out about Enphase, right? The other one is CrowdStrike. So CrowdStrike, I own, you own. It's been a big winner, but the past few years, I've struggled with the valuation. Just the multiple that it trades for, using price to sales is not perfect, but it's useful, I think, in this case as a starting point. I've just continued to struggle with the valuation with the business, particularly coming out of last summer. We're coming up on a year for the outage, the massive outage. Millions of Windows computers were down, affected hundreds of thousands of people. And the stock trades for, last I saw, 29 times sales. And what I've seen when I start looking at their financial results is far more deterioration than I think a lot of people are prepared to acknowledge. Yeah. Revenue growth was roughly 20% last quarter, right? And here's the thing. We continue to see the growth rates come down, and that's fine. Growth rates are going to come down. But what I've really started to pay attention to with these companies where the growth rates are coming down is, but what is the growth dollars? Maybe revenue was up 25% in Q2 of last year, but it's only up 20% in Q2 this year. But how many dollars of revenue did it add? Did it add $100 million in revenue last year? Again, these aren't CrowdStrike numbers. I'm just putting them out there. And now it's 20% growth, but was it also $100 million? And what we're starting to see is some of those dollar numbers are getting smaller. If the dollar numbers were the same or bigger, I'm less concerned about that.
Yeah.
But one number in particular with CrowdStrike that I've been laser focused on is net new revenue. Their net new revenue on a growth rate number and the dollars, they've been smaller 3 quarters in a row, right? So they're attracting less business. They're winning less net new business.
And here's a metric that's tied to that exact thing that I've had on the screen here for the last minute or so, which is their dollar-based net retention rate. So
yeah,
I remember, Jason, and you do too, they had that same slide in their earnings deck every single quarter that basically the way they guided it was over 120%. And you can see it jumped around, but it was always over 120% until the outage. And then it slipped below to 119 for a few quarters, then down to 118, then 115, and then 112. So there's absolute deterioration here. And that's a metric that shows what current customers are spending versus what they spent the year ago. So they're still spending more than they did. 112% is better than having it be below below 100, but certainly it's a deterioration. And that's tied exactly to what you were just talking about, net new ARR. They're both saying the same thing, that they're getting less business either from new customers or from existing.
So even with that deterioration going on over the past year, investors, so the outage happened in July, right? The stock crashed. And I think the multiple fell down to close to 15 times sales, right? The stock got hit pretty hard. It trades for 30 times sales, 30 times sales. I made a decision. Last week, I sold half of my CrowdStrike. And I've decided to start reallocating that into other companies in cybersecurity, including, and I've written about this a little bit in our Discord. It's one of the channels that we have set up, is Only Good Options as a thread that we have in Stock Ideas, where people that trade options write about options and people can ask questions that we can answer. But I decided to create sort of a synthetic long in SentinelOne. So where I've sold some puts and I use that premium to buy some calls. It's at a different strike price. So it's not truly a synthetic long, but it basically works the same way as owning shares. And it's giving me some exposure to what I think is at less than 7 times sales, 6.5 times sales. And all of the metrics are getting stronger in terms of their margins are getting better. They're right at the cusp of generating free cash flow. And yeah, that multiple is because their stock-based compensation is egregious as a percentage of revenue, but it's priced appropriately for that, right? So again, the idea of looking for multiple winners and seeing a business that I think has become so dislocated with everything that's going on with the business and the way the market is valuing it. Again, I still think CrowdStrike is built to probably be a big winner over the long term. I just don't think the market's fully recognized. Maybe there's less great stuff going on with that business, and maybe a little bit more opportunity with other stocks in the industry.
Yeah, you and I disagree on this a little bit. I agree that the market has it priced expensively, but it always does. And to me, that's telling me the market believes that this is a short-term bump in the road and it'll be fine over the long term. I haven't bought recently. I did buy, I want to say maybe a month after the outage when it was probably closer to 15 times sales, because I have always thought this would just be a thing they have to fight through and that they would be fine in the long run. And again, this is a perfect example again of this is the decision every individual investor has to make, right? CrowdStrike's a perfect example because you and I view it differently from each other, even though we're both fans of the business. I'm happy to hold shares and not sell and just wait till this recovers, buy more down the road. You took some off the table because of valuation, and maybe you have a little less conviction that they're going to maintain the lead they had once they're through all this. But it does line up with all the things we were talking about, right? This is a company that absolutely has long-term tailwinds with the industry. It has a competitive advantage. It is, if not the leader in the cybersecurity space, it is certainly a leader. Just the growth alone in cybersecurity writ large should keep them at that lead, is if they don't give up too much share over the next coming quarters from the outage of last year. Again, resilient to economic conditions. I think cybersecurity is probably one of the last things you're going to cut as a business. You may not add as much new things if you don't need them in a tougher time, but you're not going to get rid of it entirely. And this will be an interesting one. You know, I said earlier, I like to look at trailing 12-month and or annual results. And when I look at that dollar net retention rate that I showed earlier, it's still trending down the last 2 years because of that outage. But if I look at this chart 10 years from now, it could end up looking like a little blip and heading back up and to the right after that. And this is where you take the short-term information, the quarterly results, the news, and you balance it against your long-term view of the company. And I think you and I have maybe slightly different decisions that we've made when we look at it that way.
Yeah. And I think part of it too is just managing position sizing too.
That's true. Yeah. I have owned less of it than you do. Yep.
Right. So those are all the factors that kind of come into play. So again, what I've done is I've tried to be patient. You were smarter than me in that you saw that opportunity to add, right? Back when the stock price really fell after the crash. So using that kind of that near-term thing is like to be opportunistic.
Well, to be fair, I want to jump in real quick because part of the reason I did that is none of my individual stocks are massive parts of my invested wealth.
Right.
So
Right.
I can be a little bit more risk on. That was a bet again. It was a bet essentially. My decision to buy in August of 23 or 24, whenever it was this is a smallish position when I compare it to my overall wealth.
Mm-hmm. Yeah.
I can buy a little more here. And if I'm wrong, I'm fine. And if I'm right, it's good. You know?
I mean, to a certain extent, look, if you want to use the word bet, every investment we make is a bet to some degree.
Yeah. I think this was a bet with a little more
case,
uncertainty behind it, though, I guess is my
Well,
point.
there was, but that was about thinking about the risk reward profile, right?
Yes.
And the exposure you had. And for me, a lot of it, was this, I already basically had about as much as I wanted to invest in the company, but I was also less certain that it was going to prove to be a great time to buy. And it was certainly a great time to buy. It's just at a point now where the right thing to do for me, again, was thinking about position sizing and the opportunity writ large. And everybody that's paid any attention to me for whatever crazy reason you want to do that over the past year, I've talked a lot about SentinelOne as a company that I think could be the other big winner in endpoints. It's kind of a pure play on that, given a little bit of time and some opportunity. And it does look like they are seizing that opportunity, that the door that's gotten open a little bit from CrowdStrike, what they've done, because is CrowdStrike still the dominant leader in the space? Yeah, it's probably really not even close. But CrowdStrike SentinelOne is clearly proven to be good enough. And again, this is to my point that I think this still will be pockets of it that are a price taker's market, right? And you can be a winner in that price taker's market as the lower cost alternative and do quite well. That's where I'm diversifying my exposure to it. Not just to manage the downside risk of a CrowdStrike, but also thinking about the total opportunity here. And sometimes you just want to be a little bit more diversified and create a basket.
I've thought about creating more of a basket in cybersecurity too. I only own 2 companies. I own CrowdStrike and Fortinet. But just to show this real quick on the screen, I just put up the annual recurring revenue for SentinelOne quarterly going back to January of 2020. They've grown that at a CAGR of 66%. So pretty good.
Yeah, that's pretty great. It's pretty great.
Now, what I don't see though, is there wasn't like a huge jump the last couple quarters, right? It looks, at least visually, I'm not doing the math on it, but visually it looks pretty steady quarter after quarter after quarter. That CAGR of 65%, it's not choppy on this chart. So it's pretty up and to the right pretty steadily. I guess that makes sense. Even if CrowdStrike is ceding share, logic would not tell you that it would all go straight to SentinelOne. I'm sure it's gone to several different competitors to the extent that it's gone.
Yeah, no, there are plenty of players in the space that it competes with. I know we're going kind of long here, but I do want to talk a little bit about some of the examples from our portfolios, because I think there's some really good lessons. And these are largely just winners for me that have done really well in places where I've been lucky enough to not get in my own way. Intuitive Surgical, I think, is a good one because I don't want to get into the details again that we've already gone through, but it's one that I've bought. I understood enough about it, and I've had enough conviction to not mess up a good thing along the way. It's enough. It's definitely my best set it and forget it investment I've ever made. And it's not even close. Mercado Libre, I think, is another one we can talk about. This is the largest individual stock holding across mine and my wife's, all of our family's investments. It's the biggest investment that we have. My first investment, I can't remember the exact numbers, but I believe I paid a total of $450 to buy 5 shares, right? The cost basis is about $85. I've bought another 5 shares a couple of years ago at a cost basis that had a comma in it, right? And that's an important one because I think it's the reminder of the idea of, averaging up is better than averaging down because you're buying more of winning businesses, and it's hard as hell to find winning businesses. The Peter Lynch, sometimes the best stock to buy is one you already own, this kind of thing. That's been Mercado Libre for me. But the key that I want to talk about is that first investment and how powerful time is as an element for you. Mercado Libre at its current price, the stock only has to go up 4% for the per share value to increase by more than my original cost basis, what David Gardner calls a spiffy pop. All I need is a 4% gain, and I get back my cost basis on those first shares that I bought. Of course, it was only 5 shares, right? It's a very small initial investment. But the point is that's how powerful time gets, is where these smaller percentages are worth a lot more money to you than they were over time. I want to talk about Trex too for a second.
Yeah, go for it.
So the reason I want to talk about Trex is because it's a good example of an extremely cyclical in-market focused company. Trex makes decking. It's the composite decking that's 95% scrap wood and polyethylene film. Trex is very much driven by existing home sales. And the existing homes market has been in the dump for really since the pandemic, way, way down. New home construction really doesn't drive Trex. It's extremely cyclical. And there have been periods where revenue has declined year over year because of the seasonality and the cyclicality of the industry. And it's really easy, if you don't know those markets well, to see problems with the business, or to say, you know what, I'm going to sell now. I'm going to get out of this market. The market's bad. And then I'll get back in. The three stupidest words an investor can say: get back in, because you won't.
Yeah.
Right? It's going to start going up before you expect it will. It will go up more than you think it should, and you won't buy back in. What I've learned as somebody that's trying to compound and still being a net contributor to Trexes that have proven to be compounding winners is seeing those down parts of the cycle as opportunities to buy more and not try to time my way in and out of it. It's let my existing position. Okay, the stock falls 25 or 30%. All right, that's going to happen. I'm deploying new money. Maybe I should be buying some Trex right now. And then start digging in and doing the research and say, okay, what's going on with the business? Is the business fine? Is this the cycle, or is this the business that's the problem, right? And then once you identify where the problem is, you figure out if the business is viable. And I've been lucky enough to add to Trex along the way to get really, really good returns. Not quite, intuitive surgical level returns, but pretty damn close for a company that manufactures decking.
Yeah. And just to circle back to Mercado Libre real quick before we wrap up, because I was looking at my own purchases of that stock. That's one where for me, it's always been balancing short-term against the long-term. I just have huge conviction in their ability to remain the big dog in terms of e-commerce and fintech in that part of the world in Latin America. And to the point where we didn't really dive into valuation at all today, but just one of the things that has stuck out to me as I've looked back on my purchases, I have some purchases from 2020, from 2021 that are beating the market handily. And the valuation I paid at that time compared to where it is now is significantly higher. And yet those individual purchases have outpaced the market. Now, granted, I was a baby investor at the time, so I think I'm talking about like $50 of stock at the time. But it just goes to show you that, again, I don't want to go down the rabbit hole of valuation at this late point in the episode, but when you're looking at short-term results and you're balancing them against your long-term thesis for owning the company, sometimes you can get in your own head about valuation. It's not that price doesn't matter, but if it really is a generational winner in that space, sometimes it'll shake out in the end and you'll be okay. So, all right, we've gone super long here, Jason, but I hope people have found this interesting from a conversation standpoint. We talked about a lot of different stocks in this episode, which we don't get a chance to do a lot. So that was fun. But before we go, I want to just remind everyone, if you enjoyed this, we would really appreciate a rating and a review on the podcast apps. You can also subscribe to our YouTube channel. You can check out our Savvy Trader if you want more stock talk. That portfolio we have there is beating the market still, which is a good thing for us. You can also check out our Patreon. We started the conversation today with a question from a member of our starter position Patreon, $5 a month, so $60 for a year. You get access to limited ad versions of the podcast. You get access to our Discord. You can talk to other investors and me and Jason. And so if that's interesting, you can check out patreon.com/investingpod and you can sign up there. And links for everything, if you missed that, are in our show notes.
Yeah, I think that's about it. I would definitely like to see a few more of you come on over to our Discord server. It's been a lot of fun. And I mean, dude, Jeff, we don't have to come up with ideas anymore.
Yeah, thank God. Someone else can do the work for us.
That is so worth you giving us $5 for us to not have to do the work that we're supposed to do. So, all right. I kid. It has been a lot of fun though. And hopefully more of you come along. I guess I'll wrap up now, Jeff, huh?
Yeah, let's do it.
Okay. All right. As always, we love to give our answers to these hard investing questions. Figuring out the short-term stuff to navigate, to not blow up your long-term results, definitely one of the hard ones to answer. Hopefully our answers helped you figure out what your answer is, but they're still not yours. You've got to make sure to come up with your own answers. You can do it. I believe in you. All right, Jeff. We'll see you next time.
See you next time.